Welcome. This is Bronson, Investor Relations at Nighthawk Equity. I'm here with Michael Blanc, the CEO of Nighthawk Equity, as well as Drew Niffin, the president of Nighthawk Equity. Welcome, gentlemen. Today we're going to be talking about the stock market. And Michael, can you talk just for a minute about stock market returns and how they're not always what they seem?
Yeah, it's interesting because a lot of investors will compare their returns in the stock market to other investment vehicles, in this case, multifamily syndications. And it turns out that they're actually not apples to apples comparison for a variety of different reasons. That's number one. And number two, the actual stock market returns are actually not what people think. So here's what I mean by that. The average stock market return, Brunson, over the last 15 years, that's from 2004 to 2018, was 9%. I'm sorry, it was 7%. Over the last 30, it was 9%. But last 15, 2004 to was 7%. That means that if you invested $100,000 in 2004 and you got the same returns as the S&P 500, it would be worth $277,000 in 2018. Not so bad, right? 7% is not so bad. But here's the thing. Here's the thing that people don't consider. Number one is market volatility. So if you actually took the annual return of the stock market, right? So 1 year it might be 15%, then 10%, then maybe -5%. That up and down, when you plug in $100,000 and you let it ride and you actually plot the beginning and the ending balance each year, when you do that, your return actually wasn't $277,000. It was actually less than that. It was $225,000, which is only a 5.6% return. So it wasn't actually 7%. That's just the average. When you just take all the averages and you average out the percentages, the actual value was only 5.6%. So it's actually much lower than what you're reading about in the papers or you're reading on Yahoo, your financial advisor is telling you.
Well, what happened between the 15 years and like the 30 years that made that difference so big? Michael, you said the 15 years was, I think, 7.5%, and the 30 years was 9%. Is one of those more typical than the other?
Well, what happens is if you plot it out, and I actually did a spreadsheet because I love numbers, as you guys may know. So if you actually plot it out, you will see the $100,000 go up by 5%, and then the second year maybe it was 10%, and then the third year maybe it was -5%. And then certainly 2008 it was like -25%. So every time that happens, it reduces the principal of the account. So in so doing, it's not an actual compounded effect. It's not like you take the preceding plus 7, and you keep compounding it. No, what happens is the principal is reduced every time there's a negative year, and there's, in a 15-year period, there has been. So it's actually not true compounding. The true compounded return was actually 5%.
Yeah, and another thing I think that we've talked about before in the past is fees, just the fees that add up, whether you have a money guy, there's different sort of fees. Can you talk about that for a minute?
So the average, so you have mutual funds and you have ETFs or index funds. So the average mutual fund is between 0.5 and 1%, and a lot of them are as high as 2.5%. Passive, and then ETFs are typically much lower than that, around 0.5% or sometimes lower. So let's assume that the average investor has a mix of both ETFs and mutual funds, and their average fee is 1 per year. So if you take a 1% fee for every return, because the S&P 500 indices, that one I quoted at 7%, that's actually reduced to 5%. That is before any kind of fees, right? So if you apply a 1% fee, so every year you tack away 1%, which isn't much, but just that one action every single year reduces your income to a 4.5% return. So it goes from a 5.06% to 4.5%. That's what a 1% fee does every single year.
Yeah, that's great. I think one thing that we're coming across is that just that there's these little things that can nickel and dime. We think the return is here when it's really not. So Drew, I know you have some more comments as well.
And I was going to comment, with Nighthawk Equity, right? We're buying properties and we're overseeing, look at them all the time, every day, emails, phone calls to property managers, visits. So we have fees also, right? So full disclosure, but our fees are baked into our financials. So the returns that we're projecting are post-fee numbers, whereas the stock market, they're giving you pre-fee numbers. So it's not apples to apples, right? Our numbers are much truer, I would say, than what you're seeing in those other asset classes. Is that accurate, Michael, for what you're?
That's right. So we already assume that the investor returns that we're projecting and delivering are actually after fees. So it's not like this where, hey, here are returns, and oh, by the way, by the time you actually get your money, it's going to be lower than that. So it's not like that at all. So fees is certainly one thing, but let's talk about taxes also, Brunson, right? So you have the 9 or 7%, I keep saying 7% over the last 15 years is your return. But let's say after 15 years you sell your stock portfolio and you're paying capital gains tax, which right now is 15%. So if you sold your $100,000 in 15 years, you pay your 15% capital gains tax. So it would take your 4.5%, this is after fees, and it pushes your return from 4.5% to 4% after you pay your taxes. Now you might say, gosh, you might have the same thing with multifamily, but your taxes in multifamily are substantially less and we have another video on this because of the depreciation. So the taxes you pay on your gains are darn close to zero. It's just the magic of real estate. It's the way the tax law is written, and with Trump becoming president, he even improved that further. So with stocks, you got to pay your capital gains, and now we're down to 4%.
The one thing I love about this too is for people that are business owners or higher income earners, it's a great way to make more money without paying more in taxes, which is really awesome, because typically if you're a higher earner, you're paying substantially more in taxes than other people. So what we do at Nighthawk Equity is we work with people like you, people that are interested in being involved, maybe have some assets, looking to try to invest and get a good return for your money. So that's what we do. If you haven't yet go to nighthawkequity.com and join the Nighthawk Investment Club. And basically there's a process where we get to know you. We get to kind of see if it would be a good fit to work together and if we'd be able to do a deal together. So thanks so much for joining us. We'll see you on the next video.